While the retail narrative focused on ad spending recovery, institutional capital quietly repositioned around a deeper, more structural story within Meta platforms. This month, Meta is up an astonishing 21%, not just on cyclical tailwinds, but on a strategic pivot that many still underestimate. Today, we're dissecting the core drivers of this surge, revealing what's truly changing and what it means for your portfolio. At its core, Meta platforms, ticker META, commands an unparalleled social graph. We're talking about Facebook, Instagram, and WhatsApp, a colossal advertising engine with billions of daily active users across its family of apps. This isn't just a network, it's a global communication utility, creating a formidable switching cost for both users and advertisers. This robust foundation provides an enduring moat. Their value proposition is clear: hyper-targeted advertising across a vast, engaged audience, continually refined by advanced AI. What's often overlooked, however, is the dual-track strategy. The core apps business, family of apps, is a cash cow, funding the long-term, high-risk, high-reward bets in Reality Labs, focused on the metaverse and AI infrastructure. But that is only part of the story, as recent performance indicates a shift. Recent quarterly results from Meta platforms, ticker META, reveal accelerating revenue growth that has consistently beaten street estimates. We've seen robust advertiser demand returning, particularly in the e-commerce and retail sectors, signaling a cyclical recovery that's stronger than anticipated. Crucially, daily and monthly active users continue to climb across their family of apps, defying saturation fears and reinforcing top-line strength. Here's where the margin metrics become interesting. The Year of Efficiency initiative has fundamentally reshaped Meta's cost structure. We're observing significant operating leverage, with headcount reductions and rationalized capital expenditures translating directly into expanding operating margins and stronger free cash flow generation. This signals a maturity in their core business, capable of generating substantial shareholder returns even amidst heavy R&D for Reality Labs. That's not the only signal portfolio managers are watching. Management commentary, particularly from Mark Zuckerberg, highlights a clear focus on two key vectors: continued operational discipline and aggressive, yet measured, investment in artificial intelligence. This isn't just buzzword compliance, it's a strategic reprioritization that permeates every segment. The messaging indicates a shift towards maximizing existing core business profitability while selectively funding future growth engines, balancing present performance with future potential. Their capital allocation strategy has also evolved. Share buybacks remain a significant component, signaling confidence in intrinsic value and a commitment to returning capital to shareholders. Importantly, corporate guidance suggests sustained double-digit revenue growth and further margin expansion, particularly in the family of apps. This is a critical factor for institutional portfolios seeking reliable earnings visibility. The next signal comes from how the broader sector is reacting. Looking at the industry context, the broader digital advertising market is experiencing a significant demand recovery. Corporate marketing budgets, which saw a pullback during periods of economic uncertainty, are now flowing back into performance-based digital channels. This creates a powerful policy tailwind for Meta platforms, ticker META, leveraging its unmatched reach and targeting capabilities to capture a larger share of renewed ad spend. However, the competitive landscape remains intense. While Meta has effectively countered threats from TikTok through Reels, the real battle now shifts to the AI arms race. Companies like Google, ticker GOOG, and Microsoft, ticker MSFT, are pouring vast resources into foundational AI models and applications, setting a high bar for innovation. This competitive pressure demands Meta's continued massive investment in cutting-edge AI just to keep pace. That leads us to a bigger question regarding terminal risk. Meta platforms, ticker META, faces persistent regulatory pressure globally. Antitrust scrutiny, data privacy concerns, and content moderation issues represent ongoing systemic headwinds. These can lead to increased compliance costs, potential fines, or even restrictions on future growth initiatives, impacting long-term earnings visibility and adding an element of policy uncertainty to the investment thesis. Something important is happening here, as governments tighten their grip. Another significant risk factor is the substantial capital expenditure required for Reality Labs and the escalating costs of AI infrastructure. While necessary for long-term vision and maintaining competitive edge, these investments currently act as a drag on overall profitability. Any missteps in monetizing the metaverse or failing to keep pace in the AI race could lead to continued capital burn without commensurate returns, pressuring the stock. The market appears to be pricing in a different outcome, but the risk remains. Looking ahead, Meta's forward earnings visibility is strengthening, driven by continued ad market recovery and the efficiency gains we've discussed. The market appears to be pricing in a sustained period of double-digit revenue growth and expanding margins for the family of apps. AI advancements are not only fueling ad performance but also beginning to show promise for future monetization within Reality Labs, creating new avenues for growth and a compelling multi-year thesis. This improved outlook is leading to a significant valuation reassessment. Institutional demand is shifting, viewing Meta Platforms, ticker META, less as a speculative metaverse bet and more as a disciplined tech giant with a robust, profitable core and optionality for future disruption. The multiple expansion reflects growing confidence in management's ability to execute on both fronts, transforming a perceived weakness into a potential strength. That's where things get interesting for portfolio managers. For sophisticated investors, Meta Platforms currently warrants a breakout watch consideration. The structural momentum, driven by efficiency gains, ad recovery, and aggressive AI integration, suggests further upside potential. However, after a 21% surge this month, tactical positioning may call for careful entry points, awaiting potential consolidation or further confirmation of margin expansion. It's about relative strength and demand recovery, not chasing every headline move. The Meta Platforms narrative has truly evolved from a growth-at-any-cost metaverse gamble to a more balanced story of disciplined execution and AI-driven growth. Understanding these structural shifts is crucial for superior portfolio performance in today's dynamic market. If you found this institutional-grade analysis valuable, make sure to hit that like button, share this video, and subscribe to SR Money News for more in-depth market intelligence designed for serious investors. We cut through the noise to deliver actionable insights you won't find anywhere else. Thank you for watching, and we'll see you in the next one.